Eric Robertsen is Global Head of Research at Standard Chartered, and he joins us from somewhere in Singapore. Eric, good to have you with us. Market expectations are quickly changing. Ed Yardeni saying a string of 75 basis point rate hike is what he's recommending or what he's looking at. Where do you sit on this camp, 50 or 75 or even 100?
Good morning. Yes, we're still in the 50 camp. We believe the Fed will deliver a series of 50 basis point rate hikes. I think we've moved into a world where inflation has stayed, frankly, much higher and for longer than the Fed expected. And so they've had to, in their communication, open the door, I guess, to the possibilities of more aggressive rate hikes. I think the simple way of explaining it is that if they don't get inflation under control now, they may have a 10-year inflation problem, and we go back to, the economic circumstances of the 70s. And I think equity markets are starting to reconcile with that prospect.
So you're here in Asia. If the Fed gets aggressive, and let's just say they do, what does that mean for other central banks here in the region or elsewhere in the world? Are they likely to follow down the same path?
Well, I think it's a really important question. I mean, if you were to ask central bankers, they would say they set monetary policy for their domestic economies. But I think we all know that in today's world, the global economy is heavily linked. For the FX markets in particular, if you were to see that kind of an aggressive move from the Fed, you'd likely see the dollar strengthen and currencies in the region weaken in response to that. So for central banks, they'll be faced with the question of, do we have to lift interest rates in a similar fashion as the Fed to make sure that our currencies don't depreciate excessively, which then raises the prospect of even more imported inflation. And so we get into this sort of self-reinforcing negative loop, which we think is very negative for risky assets.
Eric, great to see you again, and welcome back to this part of the world. It's been a long time. So, if you're looking for a series of 50 basis point hikes, maybe a couple of days ago that might have been kind of the consensus. Obviously, things are changing so fast. It seems as though what you're suggesting is kind of out of fashion now. And I got to ask you, what do you think the Fed's sort of thinking or strategy is right now? That a string of 50s, is that going to be enough to bring up unemployment and to bring down demand, because there's not much they can do in terms of supply, right?
Well, that's absolutely right, Martin. And first of all, I think what the Fed is wrestling with is the very real possibility that the type of inflation that we're seeing today is not the kind of inflation that monetary policy has any power over. And as you correctly alluded to, that's related to supply shocks that we're seeing across a number of goods and services. And so simply raising rates by 50, 100, 150 basis points may not put more wheat or more oil into the marketplace. So the second question that spills out of that is, what is the Fed prepared to tolerate in terms of a growth slowdown or a deterioration in the labor market? I think a couple of months ago, they would have said, look, we'll hike as much as we need to when we recognize that growth will slow. I think the new question they have to ask themselves is, if we hike sufficiently to get inflation under control, are we prepared to accept a recession? And I think that's, again, what markets are starting to grapple with.
Yeah, part of the recession, of course, and I know you've been doing a lot of thinking and work on this, is the impact it's going to have on poorer countries, poorer folks, especially on the food side. I mean, this is about as basic as it gets.
It certainly is. And look, the sad truth of the matter is that for many what we call lower income emerging economies, they did everything they could from a monetary and fiscal point of view to get through the COVID crisis. And now they're being hit with a food and energy crisis. And that has really significant implications for growth. I mean, the fancy way of saying it is that we're going to experience a period of demand destruction for a number of these emerging economies. And I think that will present quite a few challenges for emerging market assets, both in local currency terms and even in hard currency terms. So I think there's a very real possibility that for many of those economies, they will plunge into recession at some point this year.
Some point this year, how bad a recession are we talking about?
Well, look, Christine, we're actually not calling for a global recession yet. I think the right way of saying it is that I think we will see a very material slowdown in global growth. That is a part of our baseline view, certainly for the major economies. But the risk is that a handful of emerging economies fall into recession in Q3 or Q4. Now, whether that pulls the global economy down completely, I think is yet to be determined. I think the more important point to make is that even if we don't get a technical recession, I think for large parts of the global economy, this combination of poor growth and elevated prices is going to feel very damaging for consumer and small business balance sheets.
Eric, got to ask you, I know you're unwilling to call a bottom here, especially for the equity market. You think we have one more leg lower to go. What about the bond market, though? Because the price action we've seen in just the last 2-3 sessions, especially at the short end on the twos, I mean, we haven't seen this kind of shellacking since probably, I can't remember, was it 2018 or something?
So by our estimate, this 2-day move in short end rates is the biggest since 1987, which obviously has a couple of historical precedents that nobody wants to think about. Look, our view has always been that the volatility would be largely centered on short-term interest rates. I have to acknowledge that 10-year and 30-year yields have gone a little bit further to the upside than we would have expected. What is also happening, and I think this is quite important, is that the yield curve has re-entered inversion territory, certainly if you look at the spread between 2s and 10s. And I think, again, that will raise all kinds of questions, both for the marketplace and for the Fed. But in terms of the equity call and the risky asset call, our view is that we haven't even started the quantitative tightening process yet. The Fed's balance sheet is still just under $9 trillion. We've seen, as you've said, some of the biggest moves in short-term financing costs that we've seen in many decades. And so I think this prospect of a very aggressive tightening of financial conditions is going to prove very, very difficult for large parts of the risky asset complex, especially equities and credit.
All right, so in short, basically, look out below. Understood. Eric, listen, great to talk to you. Fantastic seeing you again. Safe travels, keep safe, and we'll do it again very soon, I hope. Eric Robertsen, their Standard Chartered Bank.